Welcome.
Good afternoon, good morning, good evening, wherever you are. Thank you very much for joining us. This is Startup Fundraising Q&A. It's 129th session, and we are going to have a blast. If you kindly bear with me for just a second, just going to see where my panelists are, and then we will get going. So bear with me, please. We've got a few guests waiting. So I've just readmitted Sarah. Let me make you a presenter again, Sarah. Can you hear me, Sarah?
Yes, I can hear you. Yes, hi.
You can, very good. Hi, how you doing?
Good.
Right,
Good.
Let's see. As always, women do things right and not the fellas. So there's we are live. I'm just telling them to chop, and I guess we can get started in a second. But for those of you that are tuning in via our live streams, whether it's LinkedIn, YouTube, Facebook, or Instagram, please be aware that unfortunately we're unable to monitor your questions there. So we've got a brilliant panel of 4 investors today. And if you do want to ask them any questions, you'll need to be here with us on Microsoft Teams. And it's quite easy to do that. You've got a link on all of those live streams that will take you onto our call here on Microsoft. But if for any reason you are unable to do that via those links, then all you need to do is just go to our site, startup-to-scaleup.club, where you'll be able to find today's session, which is Startup Fundraising 129, and then click on that. Once you click join, It's a quick registration, as you can imagine, and then you'll be in on our call here on Microsoft Teams. And here you can ask our brilliant panelists any questions you may have on fundraising. The way we're going to do this is quite simple. We'll go through some quick introductions, and then the fundraising panel will give us their biggest do's and don'ts when it comes to early stage fundraising, and then we'll open it for questions. Now, if Robert, if you wouldn't mind closing your video, we're keeping it audio only, that would be great. So the point I was trying to make is that in terms of asking questions, it's very, very easy. All you have to do is join us here interactively on live Microsoft Teams, basically on the audio here, and then you type your question in the chat. We then give you the mic, you introduce yourself, and then fire away. Robert, can you hear us?
I hear you, and apologies, I had a technical issue to joining you. I'm sorry I'm a little late.
No, that's okay. Would you mind closing your camera, please, Robert, so that we can all keep this audio only? Good man, thank you very much. Right here, so here's what we're going to do. If you have any questions on fundraising today and you'd like to ask our panel, then start getting those questions ready now. Your questions, by the way, when it comes to fundraising, they can be on anything from, I don't know, when's the right time to start raising money? Who do you speak to? Do you go to a crowdfund or a VC or an angel? How much should you ask for? Maybe you are unclear about your pitch deck or data room or valuations, or how do you get your due diligence done, or maybe how do you reach out to an angel investor, or perhaps should you apply for a grant, and all that jazz. This is the hottest place to be in the UK for the next 56 minutes. So again, just a reminder, if you're viewing this and hearing this via the live streams, LinkedIn, Facebook, YouTube, or Instagram, please be aware that we're unable to monitor your questions there. So you need to come here onto our Microsoft Teams call, and there's a link on all of those live streams, either in the comment or at the top of your live stream. Now, without further ado, we'll have some quick introductions, and then we'll open it for questions. My name's Anton Call. I'm an Albanian in London working with startups. Normally, right after they get investment, I embed within their teams and help them hire and keep the right people. I also do some work with a few other startups as a growth advisor and some accelerators. And lately, I've been helping some angels and family offices with their due diligence and assessment. We'll start with the lady of the house, Sarah, and then Tommy, then Alessandro, and then Robert, please.
Thanks, Anton. Can you hear me all right?
Yes, we can, Sarah.
Can you guys hear me? Okay, all right, great. So I'm Sarah Antor, also a transplant. I'm an American who lives in Munich, Germany. I've been in Germany for almost 20 years, so kind of best of both worlds there. My background is in investment banking. I'm also a lawyer, US licensed lawyer, and I've been working in sort of with tech startups for the last decade. So most of the work I've done has been in the fintech space, working both on regulatory issues as well as AI. And I have raised, have launched my own VC fund. So I'm relatively new to being a VC investor. However, I've worked with, as I said, worked with startups, especially on the fundraising side of things, and I've got lots of tips and tricks that I'm happy to share today. We are Helena Capital, which is a later stage fund, so a Series B fund, 200 million, that we're investing into really technologies that support global supply chain resilience, decarbonization, and, as you might have guessed, fintech solutions. Thanks, Anton.
Thank you very much, Sarah. Tommy?
Hi, everyone. My name is Tommy Breen, and I'm a senior advisor at the growth stage. So we are a capital raising platform, and we support businesses, as our very on-the-nose name gives away, businesses that are already at their growth stage, so typically looking to raise Series B capital or later, right up to pre-IPO rounds. So in numerical terms, you typically start to work with businesses that are looking to raise in and around 15 to 20 million dollars and right up into around sometimes going into the hundreds of millions. Outside of that, I'm also a mentor at Founder Institute, so do a lot of work with earlier stage founders from as early as ideation to MVP and launch of their idea, so guiding them through that process as well.
Should I go next, Anton?
Yes, Senor Melle. It's your turn, and then Robert, please. Thanks, Tommy.
Excellent. Yeah, thank you, everyone. Welcome, everyone, and good afternoon. I'm Alessandro Mele. I'm Italian, but I've been living in England since '95. I've been working in finance for the last 30 years, although over the last 15, I've been an active founder myself as an entrepreneur, as well as moving into advising other founders on fundraising, capital raising, investor readiness, and strategy. And for the last 10 years, very much focused on impact and sustainability. So I really enjoy supporting founders who have the ability to develop solutions to social and environmental issues. So I'm joining today, especially in my capacity as co-founder and CEO of Fin, which is an FCA-regulated financial advisory firm based in London that supports entrepreneurs in clean tech, agri and food tech, as well as education and future work with fundraising and growth and investor readiness. We typically work companies in Series A and Series B and beyond, wherever there is really the need for a very institutional support to the fundraising process.
Brilliant. Thank you very much, Alessandro. Last but not least, thank you for joining us for the first time, Robert. The floor is yours.
Thank you. Thank you very much, Anton, and everybody. So Robert Hoken, I'm managing partner at Greenbackers Investment Capital. My backstory is, as we've heard, a number of expats on this call. I've been in the UK 35 years, from Chicago originally. My background is mergers and acquisitions, mainly acquisitions in corporate land. So previously with ABB and then Marconi. I've spent the last 20 years in clean tech, helping companies raise capital. We're clean tech specialists, mainly seed stage through Series C. Our sweet spot is between 2 and 20 million sterling. We're an advisory. We're a platform with roughly around 3,500 funds on panel that we are leveraging into the clean tech and climate investment space. It's a global program. I'm based in the UK, originally in London and now in Glasgow. So if you ever come up to Scotland, very happy to meet with you face to face. Hope that's helpful.
That's brilliant. Thank you very much to all four of you. Well, you've heard them, people. We have got a stellar panel with us today, and they're going to be here now for the next 48 minutes and 48 minutes only. You've got your chance to ask this panel anything you want in terms of fundraising to take your business to the next stage. As I reset the conversation, perhaps my panelists want to start thinking about certain do's and don'ts that are important to them and they've seen in the startup ecosystem. So do's and don'ts of early stage fundraising. And don't worry about repeating stuff that you might have said in the past. in our Q&As, because unfortunately, we founders tend to make the same mistakes over and over again. So a quick reset. This is Startup Fundraising Q&A 129. We've been doing these for almost 4 years now, and we've had over 270,000 people that have come through these rooms, where we've held about 2,000 founders so far. We are live streaming this on LinkedIn, YouTube, Facebook, and Instagram. However, unfortunately, we're unable to monitor your questions there. So if you do have any questions for us, please come join us here interactively on Microsoft Teams. There's a link in the comments of all of those live streams for you to directly join us on Microsoft Teams. But if you can't work that out for any reason, then please just go to our website, StartUP-to-ScaleUp.club, and look for today's session, Startup Fundraising Q&A 129. Click on that, and as soon as you click join, it's a quick registration, and it brings you in to our conversation. Now, as far as your questions today, by the way, they can be on anything to do with fundraising, so there's no reason to be shy, because there literally are no wrong questions. Now, also, if your questions today are not on fundraising, please save them for the other conversations we host. We're currently doing 6 of them: Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising, second Friday of the month it's legal, and third Friday of the month it's finances. They're all from 12 to 1 p.m. UK time, and you can RSVP to any of them via our site, StartUP-to-ScaleUp.club. And actually, when you get to that site, you might want to join our WhatsApp group, either top or bottom of the page, where you'll be able to get alerts for future conversation. And one last announcement, if I may: we have launched our Startup of the Month competition, where throughout the month of March, we will feature one female-founded startup in all our Q&As. That's 19 events, and the competition, or the entry, the deadline to enter that competition is tomorrow evening. So you'll need to enter with a 1-minute video, and it's UK registered companies. When you go onto our site, StartUP-to-ScaleUp.club, click on the menu there, and there's a link that says Startup of the Month, and you can follow the criteria there. But now, without further ado, let's start with some quick do's and don'ts. Let's keep it to 1 minute each, please, panelists. So I guess, again, this time we can start with Sarah, then Tommy, then Alessandro, then Robert, please.
Okay, thanks, Anton. So I'll keep it brief. I think if I give my sort of top 3 do's, I would say number 1, use your network. Especially, I think we tend to not recognize how broad our network is, so first and second degree. But take a good look at your LinkedIn network, your personal network, to make sure that you're letting people know that you're out there and you're fundraising. Number 2 is do your homework. So alongside that, understanding your network and who can connect you to who, doing your homework to understand angel investors out there, early stage VC investors, depending on how far along you are, and understanding what they invest in. So do your homework. It's kind of embarrassing if you get on a call with an investor who has nothing to do with your space, or is not sort of interested in your stage. That's okay, but you want them to appreciate you enough to provide you with additional introductions, and they won't do that if they think you're not doing your own homework. So it helps you and it helps them, and it will make your life easier. The third piece is understand what your current runway is. How much money do you currently have, and how far is it going to get you? So your runway, and what are you going to do with the capital if you receive it? Not necessarily what your needs are, but what are also your wants. So don't sell yourself short it's possible that you actually get more money than you need, quote. But what would you do with it if you got the money? What are you going to put that money towards? And understand that before you start the conversation. Thanks.
Thank you, Sarah. Tommy, your minute of glory starts now.
Yeah, I'll just pick up on one of the things that Sarah said and elaborate a bit more. And, you know, understanding investors and, you know, founders need to understand, you know, the type of investment they should be going for and, you know, what the potential is for their business. So a lot of, you know, founders with tech startups, you know, automatically assume they should go after VC funding, but, you know, VC funding requires your business to be what's known as venture backable, which means it's got to have really the opportunity for that business, if it's successful, to grow to be worth into the hundreds of millions. And for most even early stage investors, they want to see the potential for that business to be a unicorn one day, so valuation into the billions. And the reason for that is VCs invest based on power law. So, you know, a small number of companies, say 10% of their portfolio, will be the ones that return the majority of the portfolio. So every business they take a risk on has to really have that outsized potential. And there's lots of research you can do to try and figure out and determine if your business is venture backable. You know, if you realize it's maybe not the right course, you know, there's still angels out there that will invest at early stage and different investors. In the interest of trying to keep this to a minute, though, I won't go into too much more detail, but I guess if anyone listening has any further questions on what deciding if you're venture backable means, you know, please jump on and ask a question. We can go into more detail on it.
Thank you very much. And by the way, for those of you that are here, please type your questions in the chat room and then I'll give you the mic. Alessandro.
Yes, yeah, all very good points from previous panelists. So trying to think what additional tips I would give. So one of the top priority do's is to surely do your research. I come up very often with founders who make statements which are unsubstantiated by any fact or research. So do your research around your market, do your research around your competition, do your research about your clients, do your research about your investors. So, you know, be prepared. I think that's very, very important. Another do that is very, very relevant is do get help. There is a lot of support out there in terms of, you know, these type of events that, you know, Antonio are putting together, but also, you know, a number of acceleration programs, government support programs, grant funding, volunteers, angel networks, etc., as well as paying for advice. I think is very important as well. So recognize your weaknesses and work on those. In terms of don'ts, I definitely would encourage any founder to avoid second guessing investors' expectations. So it's very important to do your own research about investors, you know, what motivates them, you know, when you're speaking to them, but also making sure that you ask a lot of questions to make sure that there is a really level playing field, because you need their money, but they need your idea and your business. So try as much as possible to have a fair and balanced relationship with them. And I'll stop there for now.
Thank you very much, Alessandro. Last but not least, Robert, please. What are your do's and don'ts when it comes to early stage fundraising?
Well, we've heard some great do's and don'ts here so far. I would add to that, start fundraising earlier than you think. You need the money. We get companies approach us with 2 to 3 months of runway left before they start to founder. Due diligence can take longer than that. So we recommend, you know, at least a minimum of 9 months from start to drawdown of funds. It can take longer. If you're in the UK, look at the enterprise investment scheme. A lot of companies, it always astonishes me in the UK when companies aren't aware of that. If you're not based and registered in the UK, ignore what I just said. I would suggest that market traction when you're fundraising is everything. Most funds that we speak to in the institutional space, whether it be financial VC, corporate venture, impact funds, they're looking at market traction. If you don't have revenue, letters of intent, paid trials, those are good things to have. And then finally, get a data room in order. And there's a lot of advice and guidance as far as what should be in a data room. There's some free stuff on our website that can give you guidance as well.
That is brilliant from all four of you, and I really appreciate that. Now, quickly, a reset of the conversation. I can see a few people on our live streams. Please remember that, unfortunately, we can't monitor your questions if you try and send me a message or type a comment or whatever it may be on LinkedIn, YouTube, Facebook, or Instagram. You'll have to join us here live on Microsoft Teams. It's audio only, so you don't need to brush your hair and look pretty. It's quite simple. Just click on the link that I put on all of those live streams. If for any reason that's not working for you, just go to StartUP to ScaleUp.club. Look for today's session, which is StartUP Fundraising Q&A 129. Click on that, click join, quick registration, and then you'll be in here. For those of you that are here already, if you do have any question in terms of fundraising for your business, there are no wrong questions and there's no need to be shy. All you have to do is just type your question in the chat and I'll give you the mic. For my panelists, I've put a question that was sent in to us in the chat. If you'd like to read that, and I'll read it out loud in a second. For those of you that do want to ask about fundraising and you're not sure what constitutes as that, it could be literally anything within that sphere. So pitch decks, when's the right time, who do you go after, how do you approach an investor, how do you do your pitch deck, how do you prepare for due diligence, how do you get your data room done, you want to talk about valuations and all that jazz. If, however, your questions today are not on fundraising, please keep them for the other sessions we do. Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising, second Friday of the month it's legal, and third Friday of the month it's finances. They're all from 12 to 1 p.m. UK time, and you can actually RSVP to any of them via our site, StartUP to ScaleUp.club. When you're there, you might also want to join our WhatsApp group and get alerts for future rooms. You'll see the WhatsApp icon top and bottom of the page. And now let's read a question that was sent in to us, although not a huge fan of questions that are sent in, but nevertheless, this is a smart home automation for energy efficiency in London, seed stage. I don't know why, but it sounds like something we've had recently. We're developing a smart home automation product that improves energy efficiency, but hasn't launched commercially yet. The question we have is that we're developing an energy efficient home automation product and looking to raise seed funding. As a pre-revenue company, how should we balance asset-based valuation, in brackets, focusing on product development costs, with market potential when communicating our valuation to investors? Given our focus on energy tech, are there common benchmarks or valuation adjustments used in UK hardware sectors that would be useful for a non-revenue stage? Right, we'll go to that, and then we'll go on to Angelique, who's put another question in the chat, and I'll give you the mic in a minute, Angelique. But for now, let's start with Tommy, Alessandro, and then Sarah, and then Robert, please. And please try to keep it to 1 minute each, please.
Yeah, I'm going to keep it to even less than 1 minute. I just think, given the profile of some of our other panelists, I'm not an expert on the sort of asset-based valuation and hardware side of things. So I think actually, rather than taking up time, probably better to let some of the other panelists who will know this better than me give their 2 cents on it, I think.
That's brilliant. And I encourage all the other panelists, if there is something that you're not quite sure, it's much better to say pass. Alessandro.
Yes. Yeah, so a lot of resources are available, easily accessible online around these topics. Of course, it takes quite a bit of time for non-experts to dig out and identify the information. But typically for pre-revenue companies, there are a number of valuation methodologies that we would recommend. The most typical one is a discounted cash flow, looking at the business plan and calculating the net present value of future cash flows of the business. The second one, which can be quite relevant for this business, could be the venture capital method, which means you look at the business plan of the business, you make assumptions around the exit timeline and exit valuation, which can be done, with both discounted cash flows and comparable analysis, and then calculating the net present value of that future exit value in today's terms, establishing, of course, appropriate discount rate based on the riskiness, the risk level of the business today. Asset-based, in terms of cost or net worth valuation, I think can be quite inappropriate for an early stage business like the one being described. But typically, if the business is really, really early stage, it can just be a matter of sensing with angel investors or even a crowdfunding platform what a valuation could be based on the market potential and the growth expectation that the business can show. So this is more of an art than a science, as you all know.
Thank you very much. And by the way, Alessandro and the other panelists, if there's any article or a link to something that you mentioned, if you wouldn't mind putting it in the LinkedIn live stream, and I've tagged all of you in the comment there, I would really appreciate it, because it means that the founders sending or asking questions live, they can view this even after. Now, Sarah, please.
Yeah, so I would agree with what Alessandro just said at the end there, that this is more of an art than a science, especially for pre-seed and sort of early stage, right? So at the same time that the investors are making their assumptions, you should also be trying to make these calculations and these assumptions yourself, just so that you come into the conversation or the negotiation, as it were, at a somewhat equal playing field. So I think Robert talked about this as well, being able to articulate your market traction, your LOIs, paid trials, partnerships, revenues, any kind of exit assumptions or partners or potential clients that could lead to an exit. These are all things that you can factor in. So again, it's more of an art than a science, but I think the more research you've done in your area, in your sector, to understand, the valuations of comparable companies, this is exactly what VCs and angels and investors are doing. So I think as long as you educate yourself in this area, then you'll be able to come to the table with a good idea of whether you're getting sort of locked into a good valuation, a neutral valuation, or possibly a not so good valuation.
Thank you very much, Sarah. Last but not least, Robert, please.
All right. Just to add to this, whatever valuation that you set for your business, you can pretty much guarantee that certainly in the VC space, that valuation is going to get tested, probably knocked down a bit. So you need to be ready for that. Things that could help you do that, I think Alessandro may have mentioned it, is getting comparables, and they may be difficult for you if it's a specific hardware play that there's not a lot of competition. There should be competition in your space, even if it's a different approach. So a useful tool that you might look at is looking at something like Bowhurst or PitchBook, if you can get access to it, and look at market comparables, look for exits, in your industry or adjacent to your industry, and maybe try to work it backwards. Showing that there are exits in your industry or in your sector is good news to VCs. It gives them confidence that, you know, if you're able to execute on your business plan, if you've got defensible IP, if you've got the fundamentals in place in the management team, that you can get to a reasonable exit regardless of what that valuation is set.
Here, thank you very much to all four of you for that. And yes, especially since the company, you're saying you're based in London, so Robert mentioned Bullhurst, and you can actually go to the City of London. They've got a small business research arm, and you can go there and actually access Bullhurst, because I know it's quite expensive, but you can access it at their offices for free and do any research in terms of private equity and venture that Bullhurst is quite good at. So look at that. Right here, for the others, please type your question here on Microsoft Teams if you've got any question for our panel of investors. And for those of you that are tuning in via the live streams, just remember we're unable to monitor your questions there, so you'll need to join us live here. There's a link on all the live streams. If you can't access it for any reason, just go to our website, startup-to-scaleup.club. Look out for today's session, which is Startup Fundraising Q&A 129. Now, I have unmuted you, Angelique. So I know you're saying don't need the mic, but if you don't mind just quickly introducing yourself and asking the panel, that would be great.
Sure.
The floor is yours.
Sure. You can hear me okay?
Yes, we can.
Oh, okay. I think that was a yes. Right.
Yeah,
I'm Angela
yes. Sorry.
Thank you. I am the co-founder of a 5-year-old company called GainX. It's enterprise software. We've had artificial intelligence in the market 4 or 5 years. Long story as to how we did that. I'm Canadian. It is a UK founded company. We're doing our second raise. We did a raise in 2022 for about 2.5 million. So we're doing another round now. And my question is, over what length of time, and a lot has changed since 2022. So over what length of time should I be looking to cover the run rate? I'm getting mixed answers for go for a year and really aggressive, make sure that you've got 2 years because it takes a long time to raise, which it does. We're looking to close in June. And so I actually thought, well, why don't we just go out to the end of 2027, which is 2.5 years, but that bumps up all the numbers. So feedback welcome, please.
That is brilliant. First and foremost, very well done on your startup, Angelique. And I don't know if I mentioned in our conversations on LinkedIn, I know you just probably heard now about the Startup of the Month campaign, but would love if you'd like to enter the competition. And as far as the right time, no, you're welcome. As far as the right time is concerned, would love to hear from the panelists, but I think just, you know, thinking out loud here, with the way things are going on at the moment, I think 2 years, it's a good idea. But if the panel want to add a bit more meat to the bone, again, please try to keep it to 1 minute. So we'll start with Robert, then Tommy, then Sarah, then Alessandra, please.
So you're on the horns of an interesting dilemma, Angelique. My guidance is, you know, raise as much as you can when you can, for as long of a runway as you can sustain. The challenge is, you know, you don't always want to be raising capital.
Yes.
You know, that can be a very, you know, distracting, as I'm sure you're learning, exercise. On the other hand, in the venture space, you may have funds coming in wanting to set milestones for them to release further tranches of funds. It's a balancing act, but I would suggest that you give yourself, with any funding round, as much runway as you possibly can, given the constraints that you might be held to milestones on it.
Thank you. Very
Thank you,
helpful.
Robert. Who was next? Was it Tommy? Yep.
Yeah, I would say, Robert's generally right. It's, better to kind of reduce the amount of times you need to go and raise. I would say it, you said somebody mentioned a year or two. I mean, it's like the benefit of it doing a 12-month runway is obviously if you execute really well, you don't have to raise as much money now, you execute really well, and then you can go and raise a bigger round in a year. But, you'll barely be closing your round and you'll be back out raising again. You've very little time to execute and prove you deserve, a bigger valuation. So I would say, certainly want to look 18 to 24 months. If you can get a bit beyond that, that's good. But you definitely want to try and give yourself close to 2 years so you've actually time to close the round and get back to focusing on the business and executing. And then, if you need to go and raise again, do. So, and I would say also, raising for beyond 2 years or 2.5 years, maybe you don't necessarily want to do, just because you give up too much equity at this stage now. If you do go and raise for a really long time, unless you can do this as your last raise ever, you might over dilute at this stage. So there is a bit of a balance, but at the end of the day, what you really want to do is just get enough money into the business to keep yourself going and push along for the next 2 years. So I'd aim to set, a floor if you can of at least capital for 18 months, but try and push for 24 to 30 months if you can, I think.
Here, thank you very much for that, Tommy. I think next was Sarah and then Alessandra, please.
Yeah, so Angelique, first, congratulations. I just think you have to remember you're doing something really hard and you're doing a great job. So keep it up. Number two, I really can't add much to what Robert said. I think I would repeat that, which is raise as much as you can for as long as you can. It's something I mentioned earlier when I was saying my kind of do's and don'ts. Think about your needs versus your wants. I don't want to genderize this too much, but I work a lot with female founders, and they often say to me, yeah, but Sarah, we only need this much. And I push them to say, think about your needs and your wants. So what could you do with more money? And I know people might laugh and say, look, if someone's throwing money at me, you're going to take it, right? But think about what you could do over 18 months versus over 24 months versus longer. So I don't fully disagree with Tommy's idea that, you don't want to take too much at this stage. I think there's a tendency that we want to follow sort of pre-seed, seed, A, B. But in this market, we're seeing a lot of skipping. So doing, a nice pre-seed or a nice seed, and then sort of skipping the next round. Call it whatever you want. Like we kind of throw those titles out the window. So I would definitely work towards raising as much as you can now, and put together a plan that you can articulate that says, this is what we need, and this is what we're going to do with the extra money. And you can also build that out yourself and say, look, we don't need all of it today, and we don't need all of it in the next 12 months, but go ahead and raise that money and set those tranches up in much the way, it's not just the VC that can ask for those tranches. You can also do that. So my preference would be, or my advice would be, to raise as much as you can now, because that's going to give you plenty of time to execute kind of on your goals and setting up additional revenue streams or whatever it may be.
Here, thank you very much, Sarah. Last but not least, Alessandro, please.
Yeah. So I echo everyone else in congratulating you for the hard work, and being an entrepreneur is not easy, as we all know. And it's good to be the last, because I have a lot of ideas coming to mind listening to the great insights from the other speakers. So maybe what I can add is, a couple of elements. One is, of course, valuation and dilution being a relevant element to establish, what amount of funding you want to raise, and that's both for the founding teams or the existing managers. I don't know if you have stock option plans, so looking at dilution as an element of assessment of how much you raise, and also for existing investors. But the second element is one of, I would say, sustainability of your funding and your needs and what you're promising your investors with the capital. Because very often I see there is an sort of implicit, unspoken contract between the investors and the founders, where the founders feel that they need to sell their soul, their life in return for the capital they're getting. And so what I mean by sustainability is really making sure that you keep in mind your personal health as well as the health of the team in terms of what milestones you commit to with the capital raised. And I'm actually a big fan of establishing the company in a way that is ready to keep raising capital. And I totally appreciate what has been said before, that you don't want to divert management attention to fundraising. But at the same time, I really appreciate in the past some of our entrepreneurs who have set up the business in a way that they can actually work in parallel between developing the product, developing the market, and building relationship with existing investors and future investors. So if you can, in a way, structure your fundraising process so that either with internal team or with external professionals, you can manage the process, spreading out, the fundraising rounds. That can be a good way for you to really establish the organization in a way that they can really deal on a constant, in a constant process with the funding needs as well as managing the relationship with investors.
Thank you very much, Alessandro. And Alessandro, if I may just add something, or not add, ask you rather. When you say to set it up in that way, what do you have in mind? Are we talking SPVs here? Are we talking an ongoing sort of crowdfunding campaign? Anything specific?
Yeah, no. So yeah, I was not very explicit probably in my explanation, but I've come across in the past companies that have set up the team in a way that allows the organization to manage the fundraising function in parallel to the other functions. So, if budget allows, maybe hiring a CFO or working with part-time advisors so that Angelique can develop the business in a way that, there's the team developing the product. You have the team developing the market access, the business development side. And then you define a function within the organization for the fundraising and the financial part of the business.
I hear. So, almost like an investor relations person that is always gonna make. Fair enough. Good stuff.
It can be a full-time or a fractional CFO, or even a part-time advisor that can help Angelique manage this process so that it doesn't have to be sort of every 1 or 2 years, but it can be even more frequent. That which means that you really establish long-term relationship with these investors, and you can manage the relationship in a much more balanced way, as opposed to the company going out to raise capital and being at the mercy of the market of that fundraising.
Well, thank you very much. Yes, Mr. Hoken.
Yeah, I wanted to chime in on the back of Alessandro's very relevant comment there on getting a CFO in place. And I know, Alessandro, that you've undertaken those types of assignments previously as well as part of your own advisory. That can be scary. The thought of taking on a high-powered CFO into your company, and the good news is, and we're seeing this as a strong trend in the marketplace. We advocate it. Is pulling in a fractional, i.e. a part-time a CFO who may have a portfolio of companies that they are working with as part of your team, either before, during, and after the fundraise itself. And so you can do that on a cost-efficient basis and still get the skill set that you need to either stress test your business plan outright, or as Anton mentioned, be an interface between yourself. Sorry, Alessandro mentioned an interface between your business and investors again during and after a fundraise. So the the good news is there's a lot of part-time fractional support out in the market. There are even platforms with cadres of fractional CFOs that you can look into as well.
Here and tomorrow we have our very first UK Startup Finances Q&A. We'll have 3 brilliant fractional CFOs on stage on the panel. Unfortunately, a bit of a sausage fest for my liking, but hopefully the month after we'll have some amazing female fractionals too. Right here, Angelique, I hope you found this helpful.
Definitely. Very, very helpful. Thank you so much. That was incredible.
It's brilliant. I'm glad. And please do join us. Would love to hear on your progress, because I really think what you've got's got proper legs and great potential. And also think about entering that competition as well.
Thank you, Anton. I'll reach out to you separately for those details.
You're very welcome. Right here, everybody, we've got 12 minutes to go. And this is Startup Fundraising Q&A 129. We've had over 270,000 people join us so far. None of that would have happened without people like Sarah, Robert, Tommy, and Alessandro. So please show them your love. And actually, if you're finding any value in our conversation today, please feel free to share it with your networks, because we could use all the help we can get to spread the good news, especially since we've had to change platforms a few times lately, unfortunately. So please do share this with, whether it's LinkedIn or whatever your place of play is in terms of social media. Your questions today, by the way, can be on anything to do with fundraising. There are no wrong questions and there's no need to be shy. However, if you are tuning in via our live streams, as I can see most of you are, unfortunately, it means that we can't monitor your questions there. There's no point in sending me a message privately or commenting or emailing or whatever else it is. So please just click on the link that leads you to our Microsoft Teams call. If for any reason that link on that live feed is not working, or you're finding it difficult, just go to our website, startup-to-scaleup.club, click on Startup Fundraising Q&A 129, then join. It's a few seconds registration and you'll be straight in to our call here on Microsoft Teams. By the way, if your questions are on other matters, we run 6 regular sessions: Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising, second Friday of the month it's legal, and third Friday of the month, which is tomorrow, it's finance. And they're all from 12 to 1 p.m. UK time. And you can join them and RSVP to any of them via our site, startup-to-scaleup.club. And actually, when you go there, you might also want to join our WhatsApp group, because there you'll get alerts for all future messages. Now, we'll go on to another question that was sent in. And this is a Glaswegian, so probably might have even come Robert's way somehow. So, we're a personalized fitness app for women in Glasgow at seed stage currently, and our fitness app basically is raising a seed round with plans for an extensive Series A within 18 months. The question we have is that our personalized fitness app is raising seed funds, but plans to raise a larger Series A within the next 18 months. What cap table structures or preemptive rights are advisable to protect founder equity whilst keeping flexibility for additional capital? Would convertible note structures allow us to maintain flexibility, or should we opt for a safe agreement to minimize cap table complexity? Wow, that's quite wordy. Right here, well, we can perhaps start with Robert, since it's in Glasgow. We can go to Sarah, then Alessandro, and then Tommy, please.
That is a little complex. So you've got some choices here. You mentioned Series A, and I don't know if you're considering a safe for that. They're mainly used by startups to raise capital for seed financing rounds, and it's viewed by some as a more founder-friendly alternative.
They are They are at seed at the moment, from what I can tell. On
Yeah,
that
I got
question,
that.
Robert.
All right, so it can be viewed by some as a more founder-friendly alternative to CLNs, to convertible notes, and it's kind of next equity financing. It's some of these things can be led by a VC fund. The price of the equity is that safe holders receive on conversion. It's lower than the price of the securities issued to VC investors in connection with next equity financing. There's a valuation cap. It's got similar conversion features, but safes lack the debt hallmarks of a convertible note. So it just depends. You may not be able to get the confidence in the coupon, in other words, the interest that you offer on a CLN. I would probably, if your seed stage, it sounds like you've got investors that have come in, previously. You might want to trial that out on your existing investors to see if they you have any indication of preference. There's something, I think it's on Practical Law on safe instruments, also on Y Combinator, who obviously pioneered those safes. So I'd need a lot more information before I could give you practical guidance. And by the way, even though I'm in Glasgow, we focus on climate and clean tech here, so I'm not sure I understand your industry enough to give you some valuable advice. I will mention that you might get some guidance from an outfit called Accelerate Her. That's a capital H, which is an angel and support network for women founders and co-founders in Scotland. So you might find some useful input there.
Brilliant stuff. Thank you very much, Robert. Sarah.
Yes. Again, I would say something similar to Robert in that this is also not my sort of sector or space. But Robert, you gave a lot more advice than I think I can give. What I would say here, and take this with a grain of salt, but my advice here would be to keep it simple. So I would advise against using a safe at this stage. The little bit of experience I have with apps in general, especially sort of B2C retail apps, is really to focus on kind of the angel network and the early stage VC, who tend to not appreciate the safe agreements the way that like a Y Combinator might. So my advice, simple, is to keep it simple. I would focus on, your seed investors. I would definitely talk to your cap table, especially if you've got some significant angels on there already. See what kind of feedback you get from those guys. And in that same vein, I would recommend two organizations. One is Alma Angels, which is a UK-based, London-based angel syndicate, also focused on female-led ventures, so female-led female founders, and diverse founders, not just female. But Alma Angels, ALMA. And the second one, also similar to what Robert said, is Fund Her, and that's also with a capital H. They help with ideation through to, I think, Series A funding. So I would speak to either or both of those groups, including maybe Robert's as well, and understand kind of what the market is right now for those safes and if it makes sense.
Good point. David Fogel, actually, of Alma, has joined us in the past on the investor panel, and also Accelerate is run by Elizabeth Peary, brilliant woman. So yeah, I'm not sure I know Fund Her, but these two are quite well known. So thank you very much for that, Sarah. And now I can't remember if it was Alessandro or Tommy, but either of you, whoever would like to go first.
Never mind. I don't really have much to add to what has been said before. So I would strongly recommend to keep it simple. And also my question would be, why not a priced round? I find 18 months to the next Series A could be quite long. A time lapse, time frame for a CLN to convert, as well as being a seed round, and then what I think is a B2C app. In addition to the networks that have been mentioned before, maybe this could be also something that might have the support of a crowdfunding platform as well. Although at the moment I understand that most crowdfunding platforms require the founders to bring all the investors cover the target funding amount. But there could be the benefit of having the added marketing, let's say, and awareness around the app through the campaign for the fundraising as well.
Thank you very much for that, Tom.
Yeah, not lots left to add. I think it's all been covered pretty well. I think if, avoiding cap table complexity, I would say absolutely convertible notes, no, because they can be quite complex, and probably Series A investors would wonder why there's convertibles. But, I guess a safe is a slight alternative to that. In the UK over the last 12 to 18 months, I have seen a kind of seed stage, a few more what are called in the UK advanced subscription agreements, but for all intents and purposes, it's just the UK version of a safe, pretty similar. So, I mean, it is an option, but, if you want to avoid complexity, as has already been said, just go for a priced round. And I guess at seed stage, typically you should be, expecting to give up 15 to 20% of equity in your business. So, if you can, I would just try and utilize some of the resources like Alma Angels that have been suggested, and just try and target going for a pretty standard priced seed round, looking to give up, hopefully 20% equity or less. And, that is the least complexity you can add to the cap table. And then just making sure the terms, if you do get a term sheet, looking at the liquidation preferences, making sure there's nothing unusual in there. So you don't want to see anything more than a 1x liquidation preferences. So anything with a 2 or 3x liquidation preference, you want to try and avoid those as much as you can. They're pretty unfounder friendly. And then there's also something else called participating liquidation preferences, which are even worse. So those types of things, but there's plenty of resources out there where you can try and see what a pretty standard term sheet should look like at seed stage. So just making sure if you do get any term sheets offered to you, you're not getting anything really unfriendly in there that could not only screw you down the line, but also turn off any potential Series A investors if there's complexity added through those types of structures.
Thank you very much to all four of you. Now, I know some of you have a hard stop at 1, but if any of you don't, I'd love to hear some parting words. So perhaps we can start with Sarah first, and then if any of the gentlemen would like to, feel free to do that too. Sarah?
Thanks, Anton. I have a hard stop as well. I've got another call, but it's always a pleasure. I really appreciate it, and see you guys next time. Thanks.
Thank you very much. Robert?
Yeah, it's been great. Thank you very much. One thing that I like to say at these sessions, it's tough out there. What you're doing, starting a business, raising funding, is tough. I think it was said in the start of the session. Sweat your personal networks. Let people know what you're doing. Don't be shy. Friends and family can matter. You sweat your LinkedIn, and you don't know who knows other people. So you almost don't know what you don't know. So ask the questions and keep pushing. Be brave. Don't give up. Keep pushing.
Here. Well, thank you very much for that, Robert. Thank you to the other 3 that had to rush out as well. Now, huge thanks to everyone that tuned in today, those of you that did it via the live streams, especially those of you that joined us interactively here on Microsoft Teams, and those that asked questions. And by the way, just a couple of quick announcements. our Founder of the Month or Startup of the Month competition for March. And tomorrow, the deadline to enter the competition is tomorrow evening. We're doing this for female founders in the UK who are 3 or less years to running their company, i.e. incorporated. You've got the details of that on our site, startup-to-scaleup.club. Click on Startup of the Month there, and you will then be featured throughout the month of March on all of our Q&As. That is 19 events that we host, and hopefully it will help you gain some exposure in terms of potential investors, potential clients, potential partners, and co-founders, perhaps early stage employees, and all that jazz. Also, we run 6 regular sessions: Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising, second Friday of the month it's legal, and third Friday of the month it's finances, and that is tomorrow. They're all from 12 to 1 p.m. UK time. They're all free, and they're all paneled by some of the top people in the country in our startup ecosystem. You can RSVP to any of them via our site, startup-to-scaleup.club. And when you get there, actually, you might also want to join our WhatsApp group. And there's an icon of that at the top and bottom of our site. As far as my parting words are concerned, just remember the startup journey can be both challenging, but also quite exciting. So try to have some fun in the meantime, and be kind to yourself and everyone else for that matter too. Otherwise, have a great afternoon. See you tomorrow, hopefully, for Startup Finance, and God bless you all. Bye-bye for now.